what most people are watching right now is the number. The round number. The psychological milestone that feels like an ending. $100. It sounds final. It feels decisive, and that's exactly why it's misleading. Moments like this are rarely about the price itself. They're about behavior, timing, and what happens when expectations collide with reality. Silver approaching a major level doesn't mean the story is complete. Historically, it means the most difficult part is about to begin. Not because prices stop rising, but because decision-making gets harder. Emotions intensify. Narratives flip. And the difference between those who navigate the move and those who don't comes down to preparation rather than conviction. If you're here for calm, research-driven analysis of markets and monetary stress before the headlines turn frantic, make Sudi your ray. Subscribe. These moments move quickly, and understanding them early matters more than reacting late. The reason $100 captures so much attention is psychological, not mathematical. Humans anchored around numbers, they feel safe, visible, and memorable. Markets know this. Liquidity clusters there. Media focus is there, and participants begin to behave differently as those levels approach. Some rush in, afraid of missing out. Others freeze, convinced they're too late. Both reactions are driven by the same mistake. Treating a level as a conclusion instead of a transition. What rarely gets discussed is what happens after a widely anticipated milestone is reached. Volatility increases, not decreases. Pullbacks become sharper. Headlines swing from celebration to warning within days. And many holders who felt confident on the way up suddenly feel exposed. That's not a failure of silver as an asset. It's a test of investors' psychology. Silver is uniquely positioned to create this tension because it sits between two worlds. It's treated as a monetary hedge during periods of financial stress, but it's also consumed by industry. That dual role means demand doesn't disappear just because prices rise. At the same time, supply can't adjust quickly. Minds don't respond to headlines. Refining capacity doesn't scale overnight. When pressure builds, it doesn't release smoothly. This is why sharp moves tend to cluster around moments of consensus. When everyone agrees that a level matters, the market forces participants to prove it. Some exit early, relieved to lock in gains. Others add aggressively, convinced momentum will carry them. The market rarely rewards either extreme. It rewards patience, flexibility, and awareness of structure. What makes the coming phase especially challenging is the broader backdrop. Bond markets are under stress. Currencies are being defended. Confidence in policy tools is thinner than it appears. In environments like this, assets that feel stable can become volatile quickly, not because they're broken, but because they're being repriced against uncertainty. This is where many silver holders get caught off guard. They prepare for the move to a headline number, but not for the behavior that follows. They expect clarity and instead get noise. They expect confirmation and instead get doubt. And without a framework for navigating that phase, conviction turns into reaction. The question isn't whether silver reaches a number. It's whether you understand what that number represents psychologically, structurally, and historically. Because what comes after isn't simple continuation. It's a different environment entirely. The gap between what people expect to happen at a major price level and what actually happens is where most mistakes are made, leading up to a widely watched milestone like $100. Narratives tend to simplify. Commentators talk about breakouts, targets, and momentum as if markets move in straight lines. But markets don't move to reward consensus. They move to test it. As silver approaches a level that's been discussed for years, participation changes. Early buyers who accumulated quietly at much lower prices begin to reassess risk. Some reduce exposure, not because they've lost conviction, but because managing gains becomes more important than chasing headlines. At the same time, newer participants arrive with different expectations. They're not thinking in terms of structure or cycles. They're responding to visibility. This is where liquidity shifts. Large numbers attract volume, but they also attract exits. When buying and selling increase simultaneously, price action becomes unstable. Moves stretch further in both directions. What looked like steady progress turns into sharp advances, followed by sudden pullbacks. That determines outcomes, not the headline. What makes the phase after a major price level so deceptive is that it feels familiar, even when it isn't. People assume the same rules apply, just at a higher number, but the environment shifts quietly beneath the surface. The forces driving silver toward a widely watched level are not the same forces that dominate once it arrives there. Before a milestone, momentum is fueled by anticipation. After it, momentum competes with realization. Gains that were once theoretical become real, and real gains change behavior. Holders begin to calculate outcomes instead of possibilities. That calculation introduces hesitation, and hesitation introduces volatility. This is also where market structure begins to matter more than sentiment. Paper markets, derivatives, and futures contracts dominate short-term price discovery. They respond instantly to changes in positioning, margin requirements, and volatility thresholds. When prices move quickly near a major level, leverage becomes unstable. Forced liquidations occur not because participants want to exit, but because the system demands it. These events feel sudden and confusing to those watching only the price. At the same time, the physical market operates on an entirely different rhythm. Industrial users don't hedge based on headlines. They hedge based on supply continuity. Fabricators, manufacturers, and defense contractors need metal, regardless of investor mood. When volatility increases, securing supply becomes more important, not less. That creates a disconnect. Paper prices can swing sharply while physical demand remains steady or even increases. This disconnect is where many silver holders misread the situation. They assume price weakness signals declining interest. In reality, it often reflects financial stress rather than physical abundance. When leverage is flushed from the system, price action looks chaotic, even as underlying pressure builds. Those without experience in this phase tend to react to the visible move instead of the invisible cause. Another factor quietly influencing this stage is currency behavior. As bond markets strain and central banks defend stability, currency volatility increases. Silver doesn't trade in isolation. It's measured against units that are themselves under pressure. When confidence in those units weakens, repricing can occur abruptly. The adjustment doesn't wait for consensus. It happens when the balance tips. This is why sharp reversals around major levels are common. They shake out weak positioning and reset expectations. The market tests conviction, not optimism. Those tests are uncomfortable by design. They create doubt, headlines, and second-guessing. And they disproportionately affect participants who entered late or without a framework for volatility. What matters here is not predicting the next move, but understanding the environment. High volatility after a milestone is not a sign of failure. It's a sign that the market is transitioning from anticipation to evaluation, from speculation to allocation. That transition is where outcomes diverge. Most silver holders prepare emotionally for the rise, but not for the reckoning that follows. And it's that reckoning, not the number itself, that defines who navigates the cycle successfully. What separates this phase from earlier moments in the cycle is that history starts to matter more than forecasts. When silver moves into territory that feels extreme, comparisons emerge naturally. People look back to prior peaks, past squeezes, and previous cycles for guidance. That instinct is reasonable, but it's often applied too narrowly. In past monetary stress periods, silver rarely peaked when confidence was highest. It peaked when confidence fractured. The late 1970s weren't defined by orderly price discovery. They were defined by currency, distrust, policy confusion, and emotional prices didn't rise smoothly to a logical endpoint. They oversold, corrected violently, and overshot again. Those moves weren't driven by enthusiasm. They were driven by fear of being wrong. What's important to understand is that these historical episodes didn't unfold in isolation. They were the result of broader system strain. Inflation expectations became unstable. Interest rates lost their signaling power. Governments responded reactively. Each response solved one problem while creating another. In that environment, silver didn't behave like a normal asset. It behaved like a pressure valve. The same structural conditions are quietly forming now. Debt levels are significantly higher. Policy flexibility is more limited. Global coordination is weaker, and information moves faster than ever. These differences, Dan Tordusaris, they amplify it. When pressure builds, It releases through the weakest points first. Smaller markets feel it before larger ones can adjust. This is why silver often looks calm right before it doesn't. The market absorbs stress incrementally until it can't. Then moves accelerate. Those accelerations aren't warnings. They're reactions. By the time they're obvious, the forces behind them have already done their work. Another lesson history offers is that volatility near major levels, isn't a sign to abandon a thesis. It's a sign to reassess behavior. The investors who struggled most in past cycles weren't those who misunderstood the asset. They were those who underestimated themselves. They didn't expect doubt to be the defining challenge. They expected numbers to be. This phase exposes weak planning. Those who anchored emotionally to a single outcome find themselves trapped between fear and greed. Those who understood that cycles include disorder are better equipped to navigate the noise. The difference isn't information, it's expectation management. What's unfolding now isn't unprecedented. It's familiar in pattern, even if the context feels new. Systems under stress behave predictably. They create confusion, reward patience unevenly, and punish overconfidence quickly. Silver doesn't create these conditions. It reflects them. The key takeaway from history is simple, but uncomfortable. The most emotionally difficult part of a cycle often arrives after the milestone everyone was waiting for. That's where narratives collapse. Certainty disappears, and outcomes are decided. What ultimately defines this final phase isn't price, but behavior. By the time silver reaches a level that once felt distant, the market has already shifted into a different psychological state. Conversations change. Confidence fragments. The focus moves from opportunity to exposure. That transition is subtle at first, then unmistakable. At this point, the question many holders quietly begin asking isn't how high silver can go, but whether they're positioned correctly for instability. That's a very different mindset from the optimism that carried prices higher. It's also where mistakes cluster. People look for certainty in an environment that no longer offers it. They look for validation when the market is designed to withhold it. What comes after a major milestone is not resolution, it's evaluation. Positions are tested against volatility. Conviction is tested against doubt. And narratives are tested against reality. Those who expected clarity often find noise instead. Sharp pullbacks feel threatening. Rapid rebounds feel confusing. Without context, every move feels like a signal to act, even when patience would be the better response. This is where many silver holders lose alignment with their original reasoning. They react to short-term moves that don't alter the broader pressures that brought silver here in the first place. Currency stress doesn't disappear because price fluctuates. Supply constraints don't resolve because sentiment swings. The forces underneath continue operating, regardless of how uncomfortable the surface becomes. The most prepared participants are not those with the strongest opinions, but those with the clearest framework. They understand that cycles end when confidence returns, not when prices reach round numbers. They recognize that volatility is part of repricing, not proof of failure, and they resist the urge to confuse movement with meaning. For others, this phase becomes exhausting. Emotional energy drains quickly when every headline contradicts the last. Decisions become reactive. The market feels hostile rather than informational. That's often the point where people disengage entirely, stepping aside just as conditions are setting up for the most consequential moves. None of this unfolds on a fixed schedule. There is no countdown. The transition happens gradually, then suddenly, and it doesn't announce itself clearly until it's already underway. That's why understanding the structure matters more than watching the ticker. If you followed this entire breakdown, you're already ahead of the most common trap. You're thinking in terms of process instead of prediction. That alone changes outcomes. I'd like to hear what you're seeing as silver approaches these levels. Are you noticing changes in volatility, sentiment, or availability? Share your perspective in the comments. These discussions help cut through the noise. And if this helped you see the moment differently, consider sharing it with someone who's still focused only on the number. What comes after matters more than what gets celebrated.